We also have Jeremy Nicholson, and Jeremy, formerly of the Energy Intensive Users Group, who I'm sure many of you know him from, and has recently joined Alpha Energy as the Corporate Affairs Director. And Jeremy is going to give us a short, well, not a presentation, but a short speech this morning. So without further ado, please welcome Jeremy.
Thanks, James, for a great introduction. Congratulations for getting here bright and early. Sorry I wasn't able to help prop up the bar here last night. I was propping up another one somewhere else due to a prior commitment, but I gather it was a fun evening. I've been asked to say a few words about the power market in the short term and what might follow, and some of the issues that are affecting your bills, our bills, and some of the issues which are likely to affect them and the uncertainties. I might touch on the dreaded B word as well, not because anyone really wants to hear about Brexit at whatever it is, 25 past 9 on a Thursday morning, but there are some issues there which I think are soluble for the power market and perhaps have been exaggerated in the press, that it's worth just mentioning. And to wrap up with what all this means for those of you who are contracting for your power. Well, of course, the power market is always largely driven by commodity prices, although, as a number of us discussed in the Electricity Forum yesterday, increasingly it's the add-on cost, it's the taxes, it's the policy measures that are starting to dominate as far as the movements in the bill is concerned. And it's great fun for analysts and advisors because complexity is a source of joy for those of us who like that kind of thing. But from the point of view of consumers, it makes life a little bit more difficult. We all know about the influence of internationally traded commodities like coal and oil indirectly on the price of gas internationally, and hence on the price of power generation here. Also depends on the supply-demand balance. And luckily, this winter, of course, we've had a mild end to a mild winter. That's been good news for consumers in terms of lower wholesale prices, less good for generators in terms of their returns. And we've not had a repeat of the sort of beast from the east that we experienced at the tail end of last year. So those of you who are on floating contracts have probably benefited from wholesale prices that might have been a little bit lower than may have been anticipated at the start of the winter. Equally, some will have taken a bit of a hit on that and in the previous winter. It's the way these things go. But of course, there are other costs as well. And one that's worth touching on is the capacity mechanism, or capacity market, which is designed to make sure there's enough dispatchable generation capacity for the occasions when the wind isn't blowing and the sun isn't shining. And we need to make sure that there's not a material risk of a deficit on supply and demand. That, as I'm sure many of you here are well aware, was the subject of a European state aid ruling. And it has been declared, somewhat surprisingly, but nonetheless legally, to be inconsistent with the EU state aid rules, and some changes are going to be required to the capacity mechanism for it to be reinstated. But this puts us in a rather difficult situation in the UK, because it means generators can't be paid for being available, which they were and were counting on being, and therefore there is a potential, I put it no stronger than that, potential impact on security of supply if this situation isn't rectified soon. The government's put forward some propositions for reform, but also in the interim that there's going to be a voluntary collecting of revenue which can't be paid to the generators until state aid approval is granted, which should tide us over. But it's always possible this could go wrong, and you might say, well, what's this got to do with the European Union, and aren't we supposed to be leaving it anyway? Well, leaving aside whether we actually will and on what date, it's increasingly unlikely, I suspect, that it's going to be the 29th of this month, but we will see. The government's preferred position is that we will remain in regulatory alignment with the rest of the EU, and regardless, I think, of the precise terms of exit, that something along those lines is likely to emerge. And unless we so-called crash out without a deal, we will still be bound, at least for any transition period, and probably further than that, by EU state aid rules. And this does mean that there are limits to what the government can do on security of supply whilst attempting to comply with these regulations. On the plus side, we have greater interconnection to the continental markets. And that's a good thing for security of supply. Of course, if the supply-demand balance tightens at the other end of the link, that can raise our prices here. But on balance, we're better off having greater interconnection. The UK traditionally has been relatively uninterconnected with continental Europe compared with the continental markets for obvious geographical reasons. We have an existing BritNed link to the Netherlands and a larger one through to France. A new French link is under construction and a possible additional one to follow. We have the Nemo link to Belgium, which became active, I think, last month or a few weeks ago. All of this is increasing flexibility, the ability to import power when it's cheaply available in adjacent markets in Europe, which is good for keeping power prices down and managing the intermittency of wind. It's a great thing, by the way, that the cost of wind is coming down onshore and offshore, and solar PV too, and to a lesser extent biomass. All these things are helping provide diversity for our markets, but the subsidy costs have been quite considerable, at least historically, and the question of intermittency becomes a problem the more coincidentally intermittent wind we have on the system. By the way, there are some days when the wind resource in the UK is generating a huge proportion of our power, and a growing one. It's not surprising. We have the world's largest offshore wind fleet. And when it's going full tilt, that's a considerable benefit in terms of displaced fossil fuels on the power system. But there are occasions when the wind speed is low across the British Isles and across northwest Europe, and those are the occasions when, from a security supply point of view, you need something else to kick in. So hopefully the capacity mechanism will be reinstated, but what that means in the meantime is that suppliers are effectively pricing in the expectation that it's going to be restored. So don't imagine that you're going to get a discount on your bills yet. By the way, if it doesn't come back in, the market will respond, but in the absence of capacity payments to keep generation open, we might see higher spiking of prices in difficult conditions. Another big factor affecting the bills in the power market is of course, network costs. And Ofgem still proceeding with their long-running targeted charging review of residual network charges. And what this means for a number of industrial and other users is that the triad regime, which has been very successful in encouraging demand response, the signals are probably going to be somewhat reduced from that. That will reduce some of the residual costs for other users, but it means those who've been involved in load management will not be getting the same rewards for it, in all probability, in the future they have in the past. Maybe that's the right way to go, but I think it's something like 1.6 gigawatts worth of triad response we have on the system. It's hugely important in terms of balancing the system, and if that isn't rewarded through the triad mechanism and reductions in network charges in that way, there's got to be some other means of procuring it. Whether that's through other balancing services or perhaps new products. And it's a matter of concern, I think, that Ofgem thought the reforms in this area were going to be relatively easy to bring in, and I'm more sanguine now, having heard about this at an MEUC event just before Christmas, having heard directly from Ofgem about this, that there's a likelihood that Ofgem are realising it's going to take longer to get this right. Better to get it right than bring it in prematurely. I don't think that means we're out of the woods on this, but it's grounds for optimism. Now, one of the great mysteries of the power market to those who are not intimately involved is why, as Dieter Helm has pointed out, and indeed at this event last year, when the price of new renewables is going down, why is the price of power generation going up? Well, part of the explanation for that is the legacy costs of previous subsidy regimes, which now look very generous, but were necessary at the time to get some of those schemes into operation. And we think of the small-scale feed-in tariff, which is coming to an end, particularly the renewables obligation, and those costs will carry on increasing a small amount for the future, but have effectively plateaued. And now, of course, most of the big renewable schemes, especially offshore wind and so on, being financed through contracts for differences. CFDs, and you'll see that as a pass-through item is going to go up and up and up on your bill. Hopefully not as fast as some of us feared. The government's concerned about the cost of all this and making sure consumers get good value for money, but don't think those costs are going to go away yet. On the plus side, the introduction of auctions for CFDs has done a great job in helping to reduce the cost of these support mechanisms to consumers. It'll be interesting to see in the next round whether offshore wind comes out even cheaper than the last one, of whatever it was, £57 a megawatt hour. I know this is for an intermittent source of power, so it's difficult to compare it with baseload production. But those are much lower prices than many had predicted a few years ago, and there's real grounds for optimism that some of these renewable costs will come out much more competitively than many of us had feared. So I think there's some unresolved business there. Some of the larger energy-intensive users are partially exempted from these costs, but I think for the rest of us, expect to keep seeing them rising. Well, what does that mean for those of you who are contracting? It's the old story. You need to understand your own appetite for risk and the ability of your business or organisation, and if you're in the public sector, what premium do you put on predictability? How valuable is it to you to know what your costs are going to be throughout the year, and indeed for a longer contract period if you're interested in longer deals? And there's no single right answer to that. Even within the same sector of manufacturing or within service sector companies, there won't necessarily be a single method of procurement that works for all companies. It'll depend on their credit rating. It'll depend on all sorts of other factors that are specific to them. And that's why you need to talk to your suppliers. You need to talk to consultants on the basis that they need to understand your specific needs. They won't always be the same. On average, of course, you save money on flexible contracts. But as I like to say sometimes, on average, you win at Russian roulette. So you just have to know that when things get difficult in the market, that you can ride through. And if you can self-insure that, if it's for example, for a large manufacturing business, if it's worth the risk that 1 in every 10 or 15 winters, you might see a surge in prices that would really hit your cash flow, but you can live with that. And it's worth it because on every other occasion you will be, on average, paying less. And if you can cope with the fluctuation, you've got the credit rating to do it, then that makes sense. But equally, there have been others that have been caught out in the past. You have to be aware of the risk you're taking on. Unfortunately, you don't get something for nothing in life. Although you might get it by accident, but you can't get it on a sustainable basis. And last thing to mention, carbon. That's every bit as important, in a sense. It is a commodity cost these days. The cost of the EU emissions trading scheme and the UK-only carbon price floor. Very substantial prices now for the EU emissions trading scheme allowance. Currently, I think, around about 23 euros a tonne. It's been a bit higher than that a few months ago, and the price came down. It's come back up again. Expect those prices to remain significant. The European Union is signing up to hugely ambitious CO2 reduction targets for 2030. And the UK will remain directly or indirectly affected by that in the future. If we stay within the European trading scheme after Brexit, either on a temporary or permanent basis, then power generators will remain part of this market, and they'll be passing those costs on. If we come out, it's one area that the government's done a bit of forward planning on, I'm glad to say. I wish they'd done more in other areas. But for the power market, they've said if we come out without a deal, without a withdrawal agreement, then power generation will be subject to an additional carbon tax, which will be at a similar level, frankly, to what the EU allowances are trading at the moment, and probably be reviewed. So in practical terms, it's going to look pretty similar the day after Brexit, whenever that is, to where it isn't. And just for a couple of concluding words of optimism on that subject, it may be calamitous in other parts of the economy or not, who knows. But on power, if the power market, or indeed the gas market, thought there was going to be some calamitous disruption for trade, you see a huge spread opening in between UK wholesale prices and those of adjacent markets. Now, I've not seen that. So there are only two possible interpretations. One is that the market thinks we're not actually going to leave, which I suppose is possible, and anything's possible at the moment. But more likely that the market thinks that this is not going to be a major problem. There are no trade restrictions for methane molecules crossing the border, or for electrons crossing the border. There are no trade quotas or anything like that. This should be relatively straightforward. And the fact that private investors have been investing in new interconnectors tells you something about their confidence. There's still going to be a trade in power and gas going forward, and if anything, our markets are going to be more integrated in the future, regardless of the particular political situation on one side rather of the link. I'm not sure if that's a sufficiently optimistic note on which to end.
Oh, very good. Thank you very much for that, Jeremy. Give Jeremy a hand. Excellent. Well, there's some food for thought there, and while you're thinking about questions that you want to ask the panel, what I'll do is ask the remaining members, so David and Mark, just to give a brief 1-minute introduction to who you are and what you do, and then we'll kick off with some questions.
Shall I go first? Want me to go? Morning, everyone. Mark Rose, Major Business Director at Total Gas and Power. At Total, what I'm responsible for is the sale of power and gas to 4 key channels: our big direct customers, our indirect channels using consultants and brokers. We have a public sector specialist channel, and we also have an export channel which buys power and gas and some renewable certificates as well.
Morning. As James said, I'm David Taylor from Bright Energy. So Bright are a relatively new challenger supplier, as James described us. But we're part of the Statkraft Group. So Statkraft, being the largest generator of renewable power in Europe, have a very strong interest in seeing renewable power continue to grow. And increasingly, they've got a very strong interest in the role that consumers are playing in the power market. So I guess we all know consumers have become a lot more active over time, particularly in regards of demand response or on-site generation. So really starting to take steps into decarbonising their own business, but also starting to get more involved in the market itself. So Statkraft are very interested in that. They manage hydro plant in Norway and have done for 120 years. So they've got in-depth knowledge of storage of water to create power, but they're very keen to understand how the commercial storage opportunity will play out in the UK. We're looking at renewable power contracts, wind, solar and hydro, storage solutions for end users, on-site generation, and kind of bringing all of that together, optimising that with a virtual power plant type approach.
Thank you very much. Excellent. Right, so who wants to kick off the questions? Do we have a question from the audience over here? Can you just explain who you are and then speak loudly because we don't have a microphone in the room?
My name is William Parker-White from public sector, the Army. Given the success of feed-in tariffs and other incentives earlier on for renewables, how would you suggest Ofgem, the outcome of their TCR and SCR to give a kickstart to battery storage?
So, battery storage. Who wants to pick that? Mark, perhaps, Total own a battery business, don't they?
We own a battery business called Saft, across the continent. It's not something we've brought strongly to the UK, although we are looking at it. It's an interesting one, the battery piece. I read an interesting stat. I think it was Ecotricity, it was in the public domain, so it was no secret, believed that 50% of the revenue from battery investment was going to come from Triad, which I suppose is no surprise. And we have explored battery opportunities, and it's quite tough. It's possibly not taking off at the pace that, well, there's a huge amount of interest, but what it lacks is a little bit of certainty and a little bit of guarantee on what you're going to get back, and the TCR just makes that even harder. But it almost comes down to an argument of how important is resilience, how important is flexibility to possibly arbitrage in the market if the market gets volatile. But with respect to how Ofgem kickstart it, I guess I don't really know. I'm not going to lie and make anything up. I'm not sure. I would like to hope that what they have to do, and I think I also read the National Infrastructure Commission have talked about this for the future, is flexibility must be rewarded. If we're going to have large chunks of intermittent generation in this country, then we're not going to be able to survive without that flexibility, and battery storage is the best place for it. So for me, there has to be some kind of mechanism that encourages flexibility. But And another point is if you look at the shape of the half-hourly curve within day, it's not particularly volatile. So there's not always that much reward, I don't feel, at the moment, if you are able to trade within day. So I'm not sure what it is, but there needs to be something. And I think there's an awful lot of organisations and government departments suggesting there has to be something, but I'm not sure anyone really has the answer right now.
I kind of echo that. I think as a customer looking at storage, I think at the minute you have to be very clear about what it is you want to do with storage. Is it, like Mark said, is it a resilience issue? So there was a lot of talk yesterday in the battery session about trying to understand what downtime means to you and how do you place a cost on that, because obviously storage is quite critical there. If you're trying to build a business case just on the commercial value, as in what can I achieve, cost savings, revenue generation, it's difficult at the minute because of uncertainty. I think getting yourself in a position where you're able to be responsive if you have storage on site, so making sure you've got the correct contract structure in place with a supplier, you're working with a supplier who's prepared to work with you to optimize that value over time, and you're able to not put all of your eggs in one basket. You know, if you had built your storage on the basis of capacity market revenues, triads going forward, FFR revenues based on prices where they were some time ago, that wouldn't stack up anymore. But there will be other revenue streams. Like Mark said, flexibility will have to be rewarded in some way because of the intermittency of renewables coming on. So something will develop, but it's how confident you are about your own use case at this time and how you'd value that, I think.
I'd echo that. I've no doubt there will be a longer-term solution in due course. The worry for investors now is they've got the uncertainty of a targeted charging review and what that might mean, the expectation of lower rewards for triad load management, the problems that you've mentioned over the capacity market, and frankly too many projects chasing a finite revenue stream. And I remember attending a battery storage conference about a year and a half ago, and there were investors there already warning that there were too many projects in the pipeline for them all to make money out of the triad end of the market.
Yeah.
And I suspect the same may be true for premium services like fast frequency response. It's a great thing there's a lot of competition out there, but they can't all make money out of the same thing. Now, I think that the part of the solution, as far as Ofgem's concerned, it's not Ofgem's job to make storage commercially viable or not commercially viable, but it is their job to make sure there's a level playing field that doesn't disadvantage storage and put undue barriers in place to its commercial viability. And we all understand that this is part of managing intermittency, and there will have to be some means of rewarding it. One sliver of hope here is that they've set up a balancing services task force to look at forward-looking charges on networks, and I suspect if other revenue streams can be found, they won't necessarily like-for-like replace what's been lost on triad avoidance, or will be, but it might help ease some of the pain. In other words, if you're not getting revenue from one stream, it's going to have to come from somewhere else. I think the trick is to try and persuade Ofgem, and I think they're getting there, not to implement one, in quotes, reform that removes a source of revenue before another one is in its place.
Thank you very much. Thank you. It's a good question, William. I think, do you have a follow-up or?
Well, I'm not really, I'm new into this energy game. I've been sort of following it closely for a couple of years now. But it seems to me that the capacity market failing and then trying to, or being ruled illegal, is an opportunity to make it legal by allowing renewables far more opportunities within the capacity market. And the best way to make the playing field level is the sort of ultimate tax, which is sort of fairly can be called unfair, is through a carbon tax.
Yeah.
So the more you have a carbon tax, the more you sort of level the playing field in the interests of beyond individuals or companies, and let everybody play their part.
Couldn't agree more.
Yes, although we're in a sort of halfway house, so there are carbon elements. I think that's the problem. There's a bit of a hodgepodge of different policies, and they're changeable. And there's, it gives a problem. There's uncertainty for investors and so on. And I think certainty is probably something that would be most desirable for the market, I would say. Anyway, thank you for the question. Right, do we have another question over here?
Yes,
it's James, isn't it?
Just a question going back, just maybe a sort of slightly old technology, but do you think we'll see any new build CCGTs coming online in the future to replace any of the existing generation, particularly things like the coal fleet and the old nuclears that are due to come out of service?
Okay, so new build CCGTs, large-scale baseload generation, gas generation. What do you think, Jeremy?
Well, the interesting thing is that if you'd asked me that question 5 years ago, like most people, I'd say, well, of course we're going to need, a new fleet of CCGTs. One of the interesting things, which I should have mentioned earlier, power demand has been going down in the UK for quite some time. There's several gigawatts of demand that previously BEIS and National Grid and others thought we might need to meet peak demand, which has not materialised. Now, there may be an inflection point at some point in the future as we start progressively electrifying heat, where that makes sense, and moving towards a much stronger representation of electric vehicles. But we're some way away from that. So who's going to invest in gigawatt scale new CCGTs under the current circumstances, at least until the remaining coal fleet's off the system? We are going to need dispatchable power, because although battery storage is fantastic, in fact it's the leading technology for fast response, it doesn't deal with longer duration periods of tight supply-demand balance, low wind for a week, that kind of thing. Certainly doesn't deal with seasonal swings in demand. So we're going to need gas as backup there for some time to come. However, it has to be said, greater interconnection with the continental markets raises a question: why would you build a CCGT here when there's a coal fleet which was presumably going to be on track for a long-term phase out in Germany, which will have to be subject to a certain amount of gas backup there. UK generators face a higher carbon price than generators do the other side of the channel. So there's an interesting question. If you're looking at it from a European perspective, why would you necessarily invest in the UK market at the moment? And it's risky for anything that isn't underpinned by a CFD at the moment. So we probably will need some capacity, maybe only a few gigawatts, but it doesn't look like anyone's prepared to dip their hands in their pockets right now.
Big investment, obviously.
Yeah, so basically you're thinking that to bring on the new investment in that kind of technology, you need a normal market investment approach.
Well, that's
For certainty, I would imagine, if you're going to invest in, it's about like nobody would be building any nuclear power stations at the moment until they get a guarantee of how much money they're going to make over the long term. I imagine it's exactly the same for gas. I know in a couple of businesses that built large gas plants, probably going live, maybe getting on for 8, 9, 10 years ago now. For a long time, they struggled to make any good money from that type of plant. So, my belief is we'll need something. The old nuclear fleet have been closing and about to close for as long as I've been in the industry, which is 20 years. They keep getting extensions because they're still safe and they're still viable. So who knows when that actually will happen. The other piece I was aware of that was quite interesting, I read an article that said if we're going to hit our 2050 carbon targets, we need 85% of all our power to come from renewables. And we all know we need a mix. We need a mix of some kind. But who's actually going to dip their hand in their pocket without any incentives? I don't know.
Great, thank you. David, have you got anything?
No, I kind of have a very similar view. I think, as Jeremy said, although we've seen demand falling, predictions for particularly electrification of transport, and particularly with the projected growth in EVs, that there's a big demand expected to come from that. So something will be required to fill that gap. But as Mark said, to get to that 85% renewable generation on the system, that's where the focus seems to be. And it is coming down to who would be prepared to invest in this kind of uncertain time in what is quite a big capital project. And I don't see it. I think, as Jeremy said, interconnection coming in from Europe, planned interconnection going into Norway, for instance, is kind of being seen as a way to solve some of that capacity issue.
Okay, so no expected new dash for gas, I think, is the consensus at this point. We've got time for another question or two from the audience. One at the front, please. Who are you and what's your question?
Daniel Kenyon, Warwick Heat Treatment. It's just been mentioned now, and it seems to be a theme that's coming through regarding the capacity market. Now, as far as I really understand why we have a capacity market, and the reason for it is for the fact that intermittent renewables are requiring us to have backup, which in itself isn't economically viable without some kind of protection. At which point, why would we be letting renewables into the capacity market when the reason for the capacity market is because of renewables causing issues of intermittency on the system to start with? I don't understand how those two things can tie in together in any sensible meaning.
Good challenge, good challenge. David, I mean, you've got a history in renewable.
And I have my own views on the capacity market. Probably not say them in such a public forum, but I think it's been a confused. The rationale for having it is the distinction between capacity and flexibility, I think, has often kind of been a bit confused. Capacity market was supposed to encourage, in my view, new capacity onto the system to kind of meet that demand for kind of peak capacity shortfall potentially. It wasn't intended to be a flexibility mechanism, although a lot of people kind of jumped onto it and thought, well, that's a good mechanism for demand flexibility, for instance. Let's put it into the capacity market, which it did solve capacity problems, but it was kind of getting a little bit muddled, in my opinion. The other big thing, I think, is capacity market then kind of got flooded with plant that already existed. It's been on the bars for years and years and years. So it wasn't adding any new capacity. So I think, personally, looking at it, that it was doomed to, not doomed to fail, but it was given a very rough future from the outset, because I think what it was there to do was muddled. And I think you're right, now kind of saying, well, renewables can come in, albeit at derated, or storage is just starting to muddy that water even further. I think there needs to be, a bit like Jeremy said earlier, mechanisms that are quite clear about what they're there to encourage and reward. Something very clearly for flexibility, something for capacity that makes sure we've always got that capacity available. And I don't think we've got that distinction clear enough yet.
I've mixed feelings about the capacity market. I think the UK's approach has been better than in some other European and other international capacity markets or mechanisms, and it's more market focused and it's more technologically neutral than some others. So it gets a tick for that. But all of these mechanisms have some imperfection in them, not least because somebody needs to make a decision as to what capacity is required on something other than a market basis before people start bidding in. But leaving that to one side, I think it's right that renewables have an opportunity to, on a fair basis, and we'll come on to what that means, to participate in the capacity market. But it has to realistically reflect their availability and be derated appropriately for that participation to go ahead. The question is, what type of period are you trying to cover? Are you trying to cover, a half-hour period, a period of days, a period of weeks, and because the derating that's appropriate will be different in those instances. Electricity storage, for example, can provide relatively extremely secure but relatively short duration output. If you're trying to cover a longer period, you would come up with a different answer. You would need to rate the technologies appropriately, and exactly the same thing applies statistically for wind. So I have a certain sympathy for the legal challenge from Tempus, because it's not just renewables, but the demand side ought to have had fair access to the market. The demand side can't do it all, but in principle, if you can reduce demand by X megawatts, why shouldn't that compete on a comparable basis as increasing supply, providing it's comparably secure? So I'm confident something will come out of this, and I do think as a matter of principle that renewables, not all of which are intermittent, let's face it, biomass being one of them, should, as a matter of principle, have the opportunity to participate, but it needs to realistically reflect the reliability of that source at the critical period you're trying to cover.
Great, thank you very much. Thank you. That was a good question. I'm afraid that we've run out of time now, so I would, if I can just ask the panel to give literally 20 second, 20 second, just brief, optimistic view, and then we'll close off. So, Jeremy, 20 seconds. I'm going to hold you to 20 seconds.
The lights will stay on. The prices will probably keep going up a bit, but it won't be as bad as some of us fear.
Thank you. Very good. Mark?
Probably. I don't want to say just to say. I think it's an exciting market. I think there's a lot of change. I think there will be a lot of innovation coming. If it's in the next 2 years, I'm not sure there'll be that much, but I think there'll be a lot happening in the next 2 years to help make the customer experience and the customer offering better for the future.
Thank you. And David, final word.
I think that the issue of decarbonisation and renewables is now kind of front of everybody's mind, and I think that's a good thing. And I think major consumers have a big part to play in terms of demonstrating leadership to future generations. And I think that is an exciting place to be for children looking at what we're doing now about the future of